Hi guys, this is Dean. Today we're going to look at the Global Yields tab in Koyfin. If you're interested, you can get 20% off Koyfin plans in the link in the description. Okay, Global Yields. A bit scary tab if you are a novice or amateur in terms of finance 101. What are global yields? Well, we're looking at the interest rates on bonds on the bond market, and this tab is pretty exhaustive. You'll have all the countries with all the different maturities. It's pretty comprehensive, pretty exhaustive, pretty deep in terms of the data you access on this page. I have the United States selected. We have the 1 year, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year, and 30-year yields represented on a linear chart there. You can change the time frame. Now, what are we looking at and why is it so dynamic? Let's talk about the bond market for a minute. If you don't know, most people are first introduced to the stock market, right, where you can buy and sell stocks. That's pretty self-explanatory, easy to understand. However, that is not the main financial market. There's a much bigger financial market in terms of volume and transactions, which is the bond market. And a bond is essentially the other side of a loan, okay? So if you made a loan to buy a house, like a mortgage, you would have a liability to the bank to pay back that loan. So you would record a liability in your balance sheet. However, if you are the bank who underwrote that mortgage, you would have an asset, right? You will receive the principal back plus interest. So you will record that as an asset in your balance sheet if you were the bank. And that would be called a bond, okay? Bonds can be bought and sold on the market. They usually come at a $100 slice. So you can buy a lot of bonds worth $1 million, right? For example, if you make a mortgage of $1 million, on the other side there may be 1,000 or 10,000 bonds of $100 that represent the other side of that transaction. Now, it's really important for me to explain this before we go any further. Let's say we issue a bond, right? We want to underwrite a bond. It will have a nominal value at the beginning of $100. That doesn't change. The principal of the bond is $100. Now, you put it on the market for sale today at $95, okay? It will be sold today at $95. So you will have a $5 interest on that bond. And so basically, if somebody buys that bond, they're going to pay $95 today. And they're going to wait 1 year, right? This is a 1-year bond. And they will get back $100 because the yield is $5. That's the interest part. So the effective yield in this scenario, it's this divided by this, right? 5 divided by 95. So we have an effective yield of 5.26%. Now, why am I explaining all this? So you can understand this page here. Why yields? We're looking at yields here, not bond prices. That's different. As you can see on the right, the values are percentages, okay? So that's the bond at issue. You pay $95, you get $5 plus the 95 back in 1 year, the 100. So the effective yield is 5.26%. Now, you put it on the market, and the market dynamics are the same as for stocks. If it's very popular, everybody wants to buy it. Everybody wants to buy those bonds or those stocks, and there's a limited supply. Well, then people will compete for the existing inventory, and therefore pushing the price up. They would have a bid war to be able to get their hands on the product. And so they will push the price up and they will raise their bids in order to obtain those bonds. So that could happen here too. Let's say this bond is very popular on the sale day. Everybody wants to buy them. And so the price goes up. The price of the bond, you sold it at 95, but then it was so popular that it increased 16%. And now it's the current price, because it's so popular, on the market is $110. Now, the bond didn't change. The underlying bond didn't change. You would still have to wait 1 year to get $5, okay? And that amount doesn't change. So the effective yield on that bond has changed. Now you're not getting 5.26%. You're actually getting less, right? Because you're not paying $95. If you buy the bond now, you pay $110 to get $5. And 5 divided by 110 is equal to 4.55%. You see, the yield has reduced. The yield went down. So therefore, when we look at the chart after this, when you see yields going down, it means the people, the investors, the participants in the market are buying bonds. They're buying more bonds and then pushing the yield down. Conversely, paradoxically, if the bond is not popular, nobody wants the bond anymore, nobody wants to buy it, and the seller needs to get rid of it, what are they gonna do to sell it, to get their hands off of it, to get out of the position? If nobody wants it at that price, they will reduce the price. Okay, the bond price will go down if it becomes unpopular. If nobody wants it, nobody wants to buy it, the price will go down. So let's say the price goes down to $77, right? It started at 95, now nobody wants them. It goes down 19% in price. It's now at $77. The yield hasn't changed. Remember, the yield doesn't change, it's $5. However, the effective yield now has gone up, because if we do $5 divided by 77, we get an effective yield of 6.49%. So you see, we started at a yield of 5.26. Now it's much higher at 6.49%. So when you see global yields going up, this is not good. It means nobody wants the bonds. Nobody wants to buy them. Nobody wants to touch them. Nobody wants to be near them. Okay, so lower yields, good. Everybody wants to buy the bonds. Higher yield, nobody wants to touch these bonds, right? So, okay, let's have a look at what we have here on Koyfin. We can see the United States, for example. There is another thing we should mention. You're probably going to think, okay, so I understand interest rates, I get the main picture. What about the Fed fund rate? What about the interest rate that they keep talking about on the TV with the Federal Reserve and Jerome Powell, etc.? Well, that's the Fed fund rate, okay? And I'm just pulling up the yield curve in Koyfin here. The Fed fund rate in the US right now is 5%, and that's that number here. So it marked at zero maturity, so 0 month. That's the Fed fund rate. We're at 5%. However, all the subsequent ones are all the different maturities, the yields on the different maturities. And these yields are affected by the market dynamics I've just described, okay? These will move around much more quickly. This will move only when the Fed decides to do so, okay? We're not looking at the Fed funds right here. We're just looking at the bonds, existing bonds on the market and the market dynamics. So we're around for, as you can see, the different maturities here, quite narrow band compared to previously. But let's have a look at other countries, right? If we go to the United Kingdom, okay, pretty high there. Spain. So different countries have different maturities available. We're around the 2%. South Korea, again, these are pretty stable countries, guys. 2.9%. So you remember what I said? Low interest rate. Obviously, it's a function of the central bank, but it's good if there is low interest rates. Okay, it means everything is pretty stable. People are buying these bonds. Russia, okay, 19% yield on Russia. So this is not means it's good. It means there's a high likelihood of Russia collapsing. The Russian government could potentially go bankrupt. That's how you should interpret the yields when you see like a 20% yield. This is what's happening in Russia right now, 20% yield on bonds. It means that investors require at minimum a yield of 20% per year to even consider lending money to Russia, right? This is exactly what we're looking at right here. So I'm not going to go through all the countries, but as you see, you have Portugal, Japan, Italy, Indonesia, very interesting emerging market, around the 7%. Again, this is EM, so emerging market. Yields a little bit higher because a little bit more risky. What else? India, the yields have been going down, but actually, well, still a bit higher than developed markets, right? We're at the 7% here. Germany, let's have a look. Germany around the 2%. We have France, China, Canada, Brazil, Australia, and then you can even find a lot more countries with less maturities, right? So we have Austria, Belgium, Bulgaria, Chile, Colombia, Croatia, the Czech Republic, Denmark, Finland, Greece. Let's have a look at Greece actually, because if we go back in time, we might see the euro crisis represented in the yields. So I've selected Greece, 2 maturities, 10-year and 20-year. Let's go back to the maximum time frame. Okay, so right now Greece is around the 3% yield. If you go back to 2015, 2016, we were around 18% yield. This is in the middle of the euro financial crisis where Greece was collapsing. The Greek government was defaulting on their bonds. So you can see represented right here. Actually, Ireland was way before that. I don't think we'll see anything. No. But yeah, and then you also have a global yield matrix here. So you can, for example, if we look at the US, you can see the different maturities and the yields for each maturity. Now, in theory, the longer you wait to get your money back, the higher interest rate you're gonna request as a buyer of the bond. However, sometimes what happens, and this is called the yield curve, and we'll see this in a later video, that you have a representation right here. This is called an inverted yield curve, right? It should be like this. It should be very straight. The longer you wait to get your money back, the higher the yield. But this is not the case, which means you remember the market dynamics. When people buy bonds and people sell bonds, that impacts the interest rate levels. This is how you end up with an inverted yield curve. So when people buy more short-term dated bonds and don't buy long-dated bonds, which therefore suppresses the yield here, but increases the yield here, because nobody wants this, they all want to buy this, and that's not a good sign for an economy. I invite you guys to have a look at this tab. It's very exhaustive, it's very interesting, and it's mandatory really to understand really what's going on in the financial markets. So yeah, this is the global yield matrix, guys, and I'll see you in the next video.